These are the 6 steps that I think that you need to take, or at least consider, if you're going to get the most out of your investing journey. A lot of people get this wrong right from the off. So I want to give you a level of confidence that if you cover off these 6, you're probably going to end up in a pretty good place. Now, it's not exhaustive. We're not going to go into detail, but it's a top line indication of some of the mistakes that I, to be honest with you, made when I originally started investing. It's also, I get a lot of comments on all of these things. People get this sort of stuff wrong from the off. So to make sure that you get this stuff right from the beginning, you're going to make a few quid in the long term. First one is around choosing the right account. So when you start investing with the likes of Trading 2 and 2, for example, you open the app, there's a number of options across the top. We've got cash ISA, we've got CFDs, we've got stocks and shares ISAs, we've got general invest account, which is called Invest in Trading 2 and 2. And you need to get this one right from the off. So if you're in the UK, we have the benefit of something called a stocks and shares ISA. That means that you don't pay any tax on any of the gains that you make within the account. You can put up to £20,000 per year into it on current rules, and it can grow to anything, and there's no fees associated with it in terms of tax. So if you put £20,000 in, it grows to £30,000 in a year. You can withdraw the £30,000 completely tax-free. Different to a pension as well, you can also take it out whenever you want. So with a pension, you can only take it out when you reach pension age, private pension age, which in the UK is currently 57, potentially rising to 58. But if you wanted to potentially retire when you were 50, for example, and you wanted to be able to access some cash that you'd saved and invested and put away, you need a different vehicle to be able to do it. So choosing a stocks and shares ISA is going to protect you completely from tax. When we look at the other accounts that you've got an invest account, right? That is not tax protected. So you put money into an invest account, you can put as much as you want in, there's no limits there, but that will grow over time. And there will be tax implications depending upon your circumstances, the salary that you earn, the interest that you make, the gains that you make, the dividends that you receive. It's going to become a self-assessment nightmare, and you're going to have to give some of those gains away to the government, and no one wants to do that. So when you first start investing, make sure you choose a stocks and shares ISA. The other thing to bear in mind is you can choose multiple stocks and shares ISAs across different platforms. So you could have 5 if you wanted. Now, I advocate for keeping it as simple as possible, but if you're in your first year and you want to work out which might be the best platform for you, you haven't decided between, for example, Hargreaves Lansdown and AJ Bell and Trading 2 and 2, and you want to split it up, you can do so long as the total deposit across the 3 accounts don't exceed £20,000, and it is your responsibility to manage that. If you go over that, there could be some implications, so make sure that you're safe. So staying with one broker, Trading 2 and 2, for example, it's going to show you right here, you can see what your allowance is, how much you've deposited so far, and how much you've got left to deposit so that you don't go over the limit. We're incredibly lucky in the UK to have this product. Only less than 6% of the population use it, but I really advocate for making sure that you do use that stocks and shares ISA. The second thing, and this is a really important one, is around timing the market. So a lot of people think that they can, and it's kind of human nature to think that, right, well, when it goes down, I'll wait for it to bottom, then I'll buy. And when it gets to the top, that's when I'll sell. So a study was done by Charles Schwab in 2022, and they ran a system where they gave $2,000 to a number of individuals, and they did a case study to work out, well, what would actually return the best. So here's the chart here. We'll refer to it again in a minute. So in the first instance, the person obviously that gets the most returns is the one that times the market perfectly. They get given $2,000. They find the absolute bottom over the course of that year, and they buy all in at that time. Now, that is incredibly difficult to do. The best professionals in the world can't do that. If you think you can time when the exact bottom is in a given year in the market, you must be some sort of savant or genius. You're better than Warren Buffett, basically. Following close behind, very close behind, is the person that dumped the $2,000 in immediately. As soon as they got hold of that cash, they dumped it in immediately. And as you can see, there's very little difference between perfectly timing the market and just lumping in as soon as you can. The third best option then is dollar cost averaging. So this is breaking the $2,000 up into 12 individual amounts and depositing it on a monthly basis into your account. And that doesn't fall too far behind lumping in, and it's a pretty good way to do it. And for the vast majority of people, that's probably the best thing to do, because you're getting your salary and you're putting in as soon as you possibly can. Then behind that, we've got obviously bad timing, which is what most people will do when they try and time the market. So that is the worst performing approach on investing across all of the 4. And like I say, unless you think you are the greatest investor in the world, you're probably better to choose one of the previous options. Now, you're never going to be able to time the market perfectly at the bottom. So either lump in as soon as you possibly can or dollar cost average, and you'll do better than most people. We don't need to overcomplicate it. It's human nature to try and think, well, it's going down, I'll wait for it to bottom. And at the times we're in at the moment is a perfect example of that. I've got so many comments of people thinking the most rational thing to do is try and time it. People that do this end up getting it wrong because you've got a buy price and you've got a sell price. And that's very difficult to get both of those things right. The other thing is it's human psychology we've got to bear in mind. So you're going to be constantly looking at the portfolio, constantly looking at the market, trying to work out what you think it's going to do. We've got families, we've got day jobs, we've got things to worry about. We're probably going to get it wrong. So either lump in or dollar cost average. Learn that as early as you possibly can because a lot of people get that wrong. The third thing is around keeping it simple. You are not going to find the next Microsoft as much as you think you will. Another study was done over a 30-year period to work out what were the best performing stocks, and actually only 2.4% of stocks beat the market. So that means naturally 97.6% of them don't. So unless you think you can find that 2.4% and you've got some sort of insider knowledge, or you work in the industry, or you have some information that other people do not have, you're probably best to stick to ETFs. Now, sticking to ETFs might be boring, and if you are so inclined, maybe it's worth having a look at a portfolio whereby you are significantly more into ETFs than you are into individual businesses. That's how I do it. So I have the majority of my cash into ETFs, but because this is a job for me, doing this sort of stuff, I am really interested in individual businesses as well. So I hold less than 10% into individual businesses. Now, I've been lucky. I've had some absolute flyers, the likes of Rolls-Royce, Lloyd's, some others that have done really, really well, but it's as much luck as it is judgment. It's like pinning up all the stocks on the wall and throwing a dart at them. You're going to miss majority of the time because 2.4% of them will beat the market. Keep it really simple. Lump in as soon as you can. Choose an ETF that's well diversified with low fees. And that brings me on to the third point, is around consistency. You got to keep going. Whatever's going on in the market, you have got to keep going. Don't worry about it. Now, if you are the sort of person that does worry about it, perhaps you need to delete your app. Perhaps you need to set up auto deposits into your account, delete your app, and not worry about it, because that's what you do with your pension. Right? Your pension, private pension, comes out every month. How often do you look at that? Barely anyone opens their pension account and has a look at how their pension is doing, and when the markets are down, tinker with it and try and move it into European defense stocks I'm seeing a lot at the moment, or whatever it may be. You've just got to stay consistent and you've got to leave it be, and you just got to keep going. This is around long-term investing, and that is what has worked for so many people for so very long, and it's the approach that I take. The fifth thing is around paying yourself first. So work out a budget for yourself. How much do all your bills and your groceries and whatever it is, your entertainment costs, and work out what that chunk is as soon as you get paid. So if you get paid £2,000 a month, as an example, can you work out that actually you can free up 10% of that? You can free up £200 that you can put into the market every single month. Then what you need to do as soon as you get paid is you need to invest that £200. If that means setting up auto deposits, do it. If you want to do it manually, do it. How can you work out a way that works for you? If you wait until the end of the month, that money will be gone. You'll have flitted it away. There'll be nothing left. If you try and wait until the end of the month to work out how much you got left to invest, you won't have anywhere near as much as if you work out a budget, decide what you're going to invest, do it consistently, do it into sensible funds, don't try and time the market, and make sure you use a stocks and shares ISA. And the sixth thing is just as important as the others. Make sure you choose a platform that has the lowest possible fees going. So I started at Hargreaves Lansdown. I learned my lesson early. Hargreaves Lansdown is a great institutional platform. It's been around for decades, and there's a lot of old money in there. However, there is a significant fee to use Hargreaves Lansdown, 0.45%. Now, that is really going to eat at your gains in the long run. That's really going to take away from your potential pot at the end. So try and find a broker that is free in terms of platform fees. Now, ETF fees you can't get away from. So you need to make sure that you choose ETFs with low fees as well. And that's going to take a bit of research. I can't tell you what to invest in. There is a free one-page download below in the description, in the bio. You can download that. It shows what I invest in and what I would do if I was starting. That's a pretty good start, but make sure you choose something that's right for you. So make sure the ETF fee is low. Make sure the platform fee is low. I use Trading 2 and 2. There's a link in my bio. If you click on that, deposit £1, you're going to get a free fractional share as a result of doing so. So not only is the platform free, you'll get a free fractional share just for depositing £1. Like I say, this is not exhaustive and there are other things to consider, but these 6 steps are going to put you in a pretty good place to get started. Now, if you want to see what my portfolio is looking like at the moment, given what's going on in the world, have a look at this video here.